Australia's central bank becomes the last one to give in and start cutting rates. They did so for the first time since 2020 earlier today. Higher for longer is taking another hit, as it has next door in New Zealand. The Reserve Bank of New Zealand cut rates by 50 basis points for the third straight time, showing that as these central banks cut, it's a warning for the entire global economy. Remember, rate cuts aren't stimulus. That's what central bankers say, and both sets of officials predictably made the same claim all over again earlier today. For New Zealand, the economy there has gone beyond the same forget how to grow that we see everywhere else, with GDP falling for 2 straight quarters. Australia, on the other hand, is only now forgetting how to grow. Therefore, the differences are only in central bank timing and pace, not the overall condition. New Zealand has been near the forefront of the global downturn, so RBNZ has been lowering rates already and quickly. Australia is just now seeing the same thing. Suddenly, the previously reluctant RBA is following along with everyone else. Rate cuts are a reaction to serious and growing economic weakness. However, central bankers themselves characterize the circumstances behind their policies, it's not what they say, it's what they do. Maybe most important of all, for all the alleged differences in official interest rate policies and economic circumstances, RBA being careful and just starting versus RBNZ, which is already cutting heavily, New Zealand, which is in the midst of a clear and obvious recession, while Australia is only recently more seriously slowing down, both countries' currencies are behaving as if there's no difference at all between them. Because in the big picture, there isn't, not in any meaningful way. It's all synchronized. Central bank policies and their differentials, even their policies at all, don't really matter. The Eurodollar's verdict does. And that has not changed whatsoever. What has changed is that Australia is finally starting to see it too. What the Reserve Bank of Australia voted to do last night, early today, Australia time, was their first rate cut since 2020. They lowered their benchmark interest rate by 25 basis points to 4.1%. They had been among the first to aggressively hike rates, going from 0.1% in the middle of 2022 all the way to 4.1% by June of 2023. But then, fearing more of an outbreak of inflation after pausing in the summer of 2023, they were one of the central banks that hiked in November of 2023 amidst the last fury of inflation panic, the higher for longer that was everywhere at that time, even as the bond market was already moving in the other direction. Basically, the Reserve Bank of Australia has been among the more hawkish central banks out there. And of course, that leaves them to be the last one to cut. And they're not without reason to think that way and to act that way, because Australia's economy really doesn't ever have recessions nor periods of sustained weakness. If anything, it's a legitimately strong economy and has been for a very long period of time. You go back to 2008 or even 2020 for that matter. In 2008, Australia had basically 1/4 of negative GDP. Even in the silent depression 2010s, you rarely see weakness in Australia's economy. They don't have recessions. For the Reserve Bank of Australia to be more cautious about consumer prices, what they call inflation, it actually makes sense in the context of how Australia's economy normally performs. So if they're now thinking we need to start thinking about economic weakness, that's more of a double type of warning. And you see it in terms of their job market as well, especially here in the 2020s. The unemployment rate has only moved up to around the 4%, 4.1% range. It's likely to be 4.1% again in January when the data comes out later today. But either way, 4%, 4.1%, that's a full percentage point below where the unemployment rate in Australia had been in 2018 and 2019 at the tail end of the 2010s. So Australia has a solid economic growth profile. GDP is rarely weak and rarely turns negative. The unemployment rate is already well below where it had been in the 2010s, and it looks like it's sticking there, at least for the short run here. So why would the RBA start cutting interest rates here? Consumer prices are in their range from 2 to 3%. What they're starting to pick up a little bit. The labor market doesn't look incredibly, certainly not as weak as it is in New Zealand, as we'll get to there. So you have to ask the question, why would the Reserve Bank of Australia cut? And here's what CNBC said. In its last policy meeting in December, the central bank said it was more confident inflation was declining that might allow it to ease policy at some stage. Australia's inflation over the 12 months through the December quarter eased to 2.4% compared to 2.8% in the 12 months through the September quarter. The RBA, Reserve Bank of Australia, has pegged its medium-term inflation target between 2 and 3%. So they're in that range, but closer to the higher end. The inflationary pressure is, quote, easing a little more quickly than expected. More quickly than expected. Where have we heard that one before? That's what RBA said on Tuesday, noting that it has gained confidence that inflation was heading sustainably toward the midpoint of its target range, but just doing so more quickly, raising the risk of undershooting. There are noticeable uncertainties about the outlook for domestic economic activity and inflation. The central bank projection is for growth in household consumption to increase as income growth rises. But there's a risk that any pickup in consumption is slower than expected. In other words, we expect the economy which has already been slowing, to begin to pick up as real incomes that are less pressured by consumer prices begin to rise. Nominal incomes don't change, but with less consumer prices, that means your spending power and purchasing power is rising relative to where it was. It's not going to be enough to fix the overriding problem, what's causing the global downturn in the first place, but at least according to the RBA and their forecast models, it's going in the right direction. It should support the Australian economy, but there's large uncertainties that begin with these forecasts, because we've heard the same thing in all these places around the rest of the world, starting with Europe, where Europe was saying we're going to get a recovery in the European economy in 2024 and maybe 2025 because consumer spending is supposed to support the economy as real incomes begin to rise, as consumer price rates begin to recede. And yet, quarter after quarter in Europe, after predicting that consumers are going to support the economy and lead it to recovery, they always admit that it comes up short. In fact, that's what they said just today. According to Bloomberg, the Eurozone's bout of economic sluggishness is lasting longer than anticipated, according to European Central Bank Governing Council member Fabio Panetta, warning that the so far resilient jobs market may be cracking. The weakness, he said, is more persistent than we expected. Take note of this, Australia. With a long-awaited consumer-led recovery failing to materialize, the Italian central bank chief said. After 2 quarters of no growth in the euro area and tensions in the manufacturing sector, that's global trade, employment is giving signs of weakening. That's what he said at an event today in Rome. And so RBA, Australia, they're just late in following the rest of the world and expecting the same things that the rest of the world has been expecting, which means eventually they're going to see the same disappointing results. And they know it, which is why they're hedging here with this rate cut. Even though Australia's economy historically is very strong, it actually has been showing signs of weakness before we even get to 2025. But now there's a growing chance, a greater chance, that weakness is going to stick around and maybe even deepen. When you look at GDP, as I said, few recessions, few negative quarters. But since 2022, the same as the entire rest of the world, Australia has been slowly transitioning from strong, just like before, to more and more forgetting how to grow. So GDP growth over the last 4 or 5 quarters in particular has slowed to a crawl, and slowed so much that it is now below its trend line. That's the thing, that's the weakness that the Reserve Bank of Australia is picking up, and that's not weakness that's specific to Australia. What it means is that Australia's economy is beginning to forget how to grow in the same way that we see all around the rest of the world. Australia is becoming globally synchronized, and that's a big warning. Over next door to Australia in New Zealand, they long since forgot how to grow. They started out with exactly the same pattern that we've seen all around the rest of the world. Look at New Zealand GDP in real terms. It started out looking just like Germany's or South Korea or a whole bunch of other ones that I pointed out in forgetting how to grow. But in the middle of last year, the global inflection that we saw around March and April of 2024, they forgot how to grow, became, holy crap, this looks like an actual recession. This looks like the recession that everyone recognizes as recession. They had 2 straight quarters of substantially negative GDP. And after the second one, or during the second one, the Reserve Bank of New Zealand said, we need to start cutting rates along with everyone else around the world, because not only are we confronting the possibility of forgot how to grow, we're actually seeing a recognizable recession in all of the statistics, including the unemployment rate, as I'll get to in a second. So as of earlier today, the Reserve Bank of New Zealand cut by 50 basis points for the third straight time. They started out with a 25 basis point rate cut last August in response to the economic weakness. They quickly accelerated to 50 basis points in October, and then it was 50 and a 50 again. And according to Bloomberg, the Reserve Bank's Monetary Policy Committee lowered the official cash rate to 3.75% from 4.25% Wednesday in Wellington, as anticipated by all 23 economists in a Bloomberg survey, because the weakness in New Zealand is plainly obvious. It will likely follow with 25-point cuts at its April and May policy meetings. At least that's what Governor Adrian Orr told reporters at a press conference. Quote, "We are looking at lowering the official cash rate a little bit quicker than what we had projected back in November because the weakness isn't going away and it's getting worse. But that's around 50 basis points by the middle part of this year," Orr said. "That comes broadly in two 25 basis point steps, and it doesn't stop there," he admitted. "We have our projection of the OCR being around 3% by year end because, again, contrast to Australia, New Zealand is in a world of trouble, and it's visible in all the statistics, including GDP and the unemployment rate." As much trouble as New Zealand is in already, they also pegged increasing risks to the downside from slower global growth, and of course they had to throw in their trade wars and tariff threats from the United States and the Trump administration. According to James McIntyre, who's Bloomberg's economist, he said the danger is that growth and inflation undershoot the central bank's forecast. There's that word again, globally synchronized there, over the median term. "We think that RBNZ will deliver a further 125 basis points of rate cuts over the next 12 months, taking the official cash rate below neutral." Again, New Zealand is one of the clearest examples of this global downturn. Forgot how to grow becoming a little bit more than just forget how to grow. And central bank rate cuts and rate actions are a response to that weakness, not a solution to it. You can see how serious the situation has gotten to be in New Zealand already. Just look at the unemployment rate. GDP does a good job in describing, but the unemployment rate. The jobless rate zoomed up to 5.1% as of the fourth quarter of last year, and that's only a tenth off of the high from the pandemic, 5.2% in the third quarter of 2020. You go back to 2017, the unemployment rate was only 4.9%. So already the unemployment rate in New Zealand is being impacted by this globally synchronized, forgot how to grow economy in a way that is at the forefront of weakness, whether it be like with Germany or Canada. It's one of those economic signals that suggests it's not just a slowdown, it's not just normalization after a red-hot recovery in 2021 and 2022, this sustainable plateau of prosperity that the pandemic era was supposed to lead to. Instead, what you're seeing is the unemployment rate zoom and blast right past normalization of what could be considered normal to become, as the Reserve Bank of New Zealand is already acting out, to become quite concerning, alarming. And the fact that it's globally synchronized means that it's not just about New Zealand. But given these apparent differences, or what are taken for differences, you would think that, with Australia just now looking at global weakness, but New Zealand being at the forefront of the global downturn, the Reserve Bank of New Zealand cutting rates much faster and more aggressively, the Reserve Bank of Australia that's just now starting to cut rates, and also even though the Reserve Bank of Australia just cut rates, they're saying they're going to go slow and cautious like they all say when they start these out. You would think that given these differences, the currencies, both of these currencies, the New Zealand dollar and the Australian dollar, would be looking nothing like one another. But there's a whole degree of global synchronization, even though they don't, on the surface, look like they're all that synchronized. It's just a difference in timing and pace for now. Where they're synchronized is not just in the currencies I'll get to in a second here, but the global background behind everything, which is what the currencies, the dollar on the other side, the Eurodollar verdict, actually represent. So you have the RBA that's been on hold since the end of 2023. Meanwhile, central banks around the rest of the world, including the Federal Reserve, have been cutting rates pretty aggressively. The Fed's down by 100 basis points since September. Meanwhile, RBA says they're just now getting to rate cuts, and they're going to go a lot slower, at least that's what they say, than everyone else. So you would think that, given the mainstream explanation of currency exchange values being interest rate differentials, especially central bank policy differentials, you would think that the Australian dollar is zooming ahead, incredibly strong, one of the strongest currencies out there because policy rates are higher relative to everywhere else, except no. The Australian dollar has been weakening and substantially weaker from the end of September through mid-January, just like everyone else, especially the global dollar shortage that erupted late November, December, and up till the middle of January. The Australian dollar right now, or at least in the middle of January at its low, was as low as it's been since April of 2020, the worst part of the pandemic, or October 2008. Australian dollar looks like copper to gold, the ratio that's down in comparison with these same levels, because it's not about central bank differentials or perceived differences in what central banks are doing. And it's not just these two oceanic dollars. It's not just New Zealand and Australia. Compare the Australian dollar with something like the Korean won. Korea's won doesn't seem like it should have anything to do with Australia's dollar, yet there's a very close correlation there as well. And another big one, China's yuan. The fact that Australia's dollar corresponds closely with all these just means it's linked together in the global system by Eurodollar factors that perceive Australia as experiencing the same problems, therefore the same level of risk aversion as, say, New Zealand, South Korea, or China. And when you stop and think about the globally synchronized world and the Eurodollar's role in it, that actually makes sense. And so what the Reserve Bank of Australia is doing by cutting rates is essentially validating this globally synchronized signal that we get through the currency. They're saying, oh, crap, we're starting to see the same weakness. We're starting to see the forgot how to grow economy. They're obviously not using those terms. We're starting to see the forgot how to grow economy show up in Australia too. Now the Reserve Bank of Australia is acting in the same way as everyone else has. Globally synchronized. The Eurodollar verdict was made a long time beforehand. And the Eurodollar verdict from the very beginning said there was never going to be higher for longer. Eventually, this forgot how to grow economy, however you want to characterize it, the outright recession in New Zealand, the forgot how to grow that's just beginning to forget in Australia, it's all the same thing. The world was impoverished back in 2021 and 2022, and the net result of that was not going to be inflationary. It was not going to be central banks holding their rates high for a long period of time. It was going to be destruction in demand that left the global economy weaker and weaker, and therefore central banks, as they always do, responding to that weakness by cutting rates. And now we have the last major central bank holdout doing the same thing for the same reasons, which is why the currencies are so synchronized. The bond market had tried to warn people. The supply shock had only one possible end. It wasn't going to be a sustainable recovery. You can't just impoverish the world and expect it all to go fine. And while there's been differences in speed and intensity along the way, the transition from the price illusion, what looked like a recovery in 21 and 22, to the forgot how to grow, and even some outright recessions, the transition was going to be variable, but it was going to happen everywhere anyway. New Zealand at the forefront of the weakness, Australia at the back end, but it's all globally synchronized nonetheless. The Eurodollar's verdict is what has mattered, and the Reserve Bank of Australia, like the Reserve Bank of New Zealand, like the Reserve Bank of India too, are simply confirming everything. Is that why Warren Buffett is selling more stocks, especially bank stocks? That's the question we looked at in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.